Welcome back. It's our first video of 2024 and you may notice something a little bit different around here because the channel name has changed from Market Movers to Markets Mapped, and you'll understand more about why that is in the coming months. But for now, let's get back on track with what's going on in the markets. It's been an eventful start to the year, and today we're going to focus on the UK because today the ONS released the latest consumer inflation report, which includes CPI. And the report gave a bit of a surprise as it showed an increase in headline inflation to 4% for December, which is up from 3.9% in November and above the 3.8% expectations. So this could signal that inflation is maybe stickier than expected. Now, another indicator that the Bank of England uses for stickiness is services inflation, as prices there tend to move slower. And that also accelerated to 6.4% from 6.3%. Now, this is the last CPI release before the next Bank of England meeting on the 1st of February, but it's unlikely to have a major impact on policy just yet. So firstly, inflation is still below the Bank of England's forecasts, and they don't expect it to return to the 2% target until 2025. You can see what they said in their report at the end of last year here. So CPI inflation remains well above the 2% target, but is expected to continue to fall sharply, 4.75% in 2023 Q4, 4.5% 2024 Q1, 3.75% in 2024 Q2. So that means the Bank of England doesn't need to rush back into rate hikes just yet. They have time where they can monitor how previous rate hikes are still filtering through and impacting the economy. Secondly, there have been other positive signs that align with easing inflationary pressures. So we have GDP, which is estimated to have declined by 0.1% in Q3 2023, which shows a potentially stagnating economy, maybe moving towards a recession. Wage growth has slowed to 6.6%, which reduces the risk of built-in inflation, which the central bank saw as a primary concern. Job vacancies have also declined, the unemployment rate increased, showing potentially a weaker labour market, and energy prices and food prices have also slowed, and these were significant contributors to cost push inflation. It's seeing higher food prices, higher energy prices that drives consumer inflation expectations. And it's also important to remember that although this was unexpected, it's only one CPI data point. It's not a trend yet. And if we look deeper into the context of the report, it also seems that some of the factors that led to a bump up in inflation are not likely to cause long-term inflationary pressures. So for example, food inflation did slow, but alcohol and tobacco prices offset this due to tax increases from the autumn statement. Christmas spending could also have led to prices increasing. But it does actually mean that the next CPI reports carry a lot more weight, especially if they show stalling or increasing inflation. Now, there are risks that we have to pay attention to, including an increase of 5% for Ofgem's energy caps in January, increasing costs for retailers, as reported by the British Retail Consortium, and a tax on shipping and the increasing risk of war in the Middle East. However, rates and borrowing costs remain relatively high, and if the economy and inflation do remain slow, then that could open up the possibility of rate cuts later this year. But for the next meeting, it's likely the Bank of England will want to hold rates for now. See you in the next one.